The latest producer price index shows wholesale inflation cooled slightly last month. Let's get the very latest from CNN's Matt Egan. Okay, we just had producer prices come in. That's the breaking news. Tell us what the numbers say.
Yeah, John, look, this is an inflation report that is coming in cool, and that is a big relief after a red hot reading the month before. So producer prices unexpectedly falling by 0.1% between July and August. Now remember, this is wholesale inflation before it gets to all of us at the checkout aisle. The annual inflation rate for producer prices cooling to 2.6%. That is better than expected. And again, that is a notable improvement from the month before. Now here's the thing though, why did this happen? One of the reasons why we're now seeing this big decline in prices, this unexpected decline in prices after the spike in July, is because there was a drop in what's known as trade services. This essentially measures the margins that businesses have. And so what it shows is that some companies are absorbing the cost of higher prices, some of which are being driven by tariffs. The problem, though, economists say, is when you see that happen, that often is a signal that they're going to pass along at least some of those costs to all of us as consumers. So that's something to keep an eye on. But when you look at the annual rate for producer prices, it does remain elevated, dipping a little bit right here, okay, but still above that 2% that would be considered healthy. Obviously way better than 3 years ago when you had about 11% for wholesale inflation. That was a nightmare. But also it's really not back to target, and it has ticked a little bit higher. John, all of this coming ahead of tomorrow's more important consumer price index, and that is going to be something that's going to be watched very closely by investors and economists and of course the Federal Reserve. You take a quick look, U.S. stock futures, not a major reaction here. I would note that any gain today would be a record high for the Dow, the S&P, or the Nasdaq.
All right. A little bit cooler on the producer side on inflation. We'll wait to see what the consumer side says tomorrow. Matt Egan, thank you very much for that. With us now, Rick Newman, author of the Rick Report newsletter, former columnist for Yahoo Finance. We always like speaking with you, Rick. Just your first reaction to this number on the producer side, this inflation number.
It's going to clear the way for the Federal Reserve to cut interest rates when they meet next week. So investors think there's about a 92% chance of a quarter point rate cut, and maybe the rest of that, the 8%, is maybe there will be a half point rate cut. Now we have to remember those are short-term rates that mainly affect banks, not long-term rates that affect mortgages and consumer loans. But that is what investors have been hoping to see. That's good for the stock market. It also does reflect that the Fed does have concerns about the job market. That would be the reason for it to cut rates in the first place. And if they're less worried about inflation, which they can be, at least according to this one data set we got today, that clears the way for them to cut interest rates.
Let's talk more about the jobs market, because hot off the press is in my hand. I have the most recent edition of the Rick Report here, and you write extensively about concerns about the job market. Job growth under Trump is the weakest since the Great Recession, you say.
Yeah, and this is based on some data I get from Moody's Analytics, but if you look at the change in total employment since Trump has been in office, it's barely positive. And if you just go back and compare this with other presidents, it's the weakest showing since Barack Obama took office in 2009. Of course, that was in the middle of the Great Recession, and we were losing a lot of jobs at that point. Just to put some numbers on it, last year job growth averaged about 168,000 new jobs per month. For the last 4 months, we're all the way down to just 27,000 new jobs per month. And a lot of that has to do with the tariffs, which have messed up profits at a lot of companies, and they're just on hold. They don't want to hire because they don't know what's happening. And also Trump's deportation policy is actually leading to a decline in the labor force. And you can say, well, those are unauthorized migrants. They shouldn't be in the labor force anyway. But regardless, it does affect the job market. And that affects hiring. So the Fed is looking at this, and it is one of the Fed's two main jobs to keep employment up. And so that is what I think that is really what they're going to start to be focused on more than inflation at this point. So again, that's why we might get some monetary stimulus coming in September.
Because of concern over the direction of jobs. Rick Newman, thanks so much for being with us. Great to see you.